studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that sunk he died.
In this slide, we begin exploring one of the most practical skills required in corporate tax preparation: understanding a client's investment documents. Many tax professionals are comfortable applying tax rules, but the challenge often begins much earlier. When a client provides a large package of investment reports and asks you to prepare the tax return, at first glance, these documents can seem overwhelming. Clients may provide brokerage statements, portfolio summaries, investment performance reports, annual tax packages, and various tax slips, such as T3 and T5 slips. Each document contains a large amount of information, but not all of that information is relevant for tax reporting. That is why the tax preparer's role is not simply to read the reports. The real task is to identify and extract the information that actually matters for tax purposes. The diagram in the center of the slide illustrates this process. The client provides an investment package containing raw investment data. Your job is to review that data and convert it into tax-relevant information that can be used for tax reporting and planning. Let's look at some of the common documents shown on the left side of the slide. Brokerage statements typically summarize account activity and holdings. Portfolio summaries provide an overview of investments and performance. Investment reports often include transaction details, gains and losses, and investment activity. Annual tax packages usually consolidate tax information from financial institutions and can be particularly useful during tax preparation. However, these reports are merely sources of information. The tax return itself requires specific categories of income and deductions. On the right side of the slide, you'll see the information that tax preparers are actually looking for. First, interest income. This may come from savings accounts, bonds, GICs, or other fixed income investments. Second, dividend income. This includes dividends received from corporations and may have different tax treatment depending on the source. Third, capital gains. These arise when investments are sold for more than their adjusted cost base and are a key component of investment taxation. Fourth, investment expenses. These may include advisory fees, management fees, commissions, or interest expenses that could affect taxable income. And finally, foreign income. This category often requires special attention because foreign investments may generate foreign taxes, reporting obligations, and foreign tax credit considerations. The key principle at the bottom of the slide captures the entire lesson. Investment reports contain far more information than a tax return needs. A tax return does not require every page of a brokerage statement or every performance chart in a portfolio report. Instead, the goal is to identify the tax-relevant information hidden within those documents. As tax professionals, we act like investigators. We review the reports, locate the relevant income and expense items, verify the supporting documents, and organize the information into a form that can be accurately reported on the tax return. The better you become at extracting the right information from investment reports, the more efficient, accurate, and valuable your tax preparation process becomes. And that skill forms the foundation for everything we will discuss in the next slides. In this slide, we move from identifying investment documents to developing a systematic process for analyzing them. One of the biggest mistakes new tax preparers make is assuming that an investment report can simply be read from top to bottom and entered into the tax return. In reality, investment reports often contain large amounts of information, and only some of it is relevant for tax purposes. That is why experienced tax professionals follow a structured workflow. Let's walk through the 5-step process shown in the center of the slide. The first step is to identify income sources. When reviewing an investment report, your first objective is to determine where the income is coming from. This may include interest income from bonds or GICs, dividend income from shares, capital gains from investment sales, or even rental income from real estate investments. Before doing anything else, you need to understand the different types of income that exist within the portfolio. The second step is to identify expenses. Investment reports often contain advisory fees, management fees, transaction fees, and interest expenses. Some of these costs may be relevant for tax purposes, while others may not be deductible. A careful review helps ensure that potential deductions are not overlooked. The third step is to identify foreign items. This area is often missed by inexperienced preparers. Foreign investments may generate foreign dividends, foreign interest income, or foreign taxes paid. These items may affect foreign tax credits and other reporting requirements. Whenever foreign investments are involved, extra attention is required. The fourth step is to verify tax slips. At this stage, the tax preparer compares the information found in the investment reports to the official tax slips received from financial institutions. Examples include T5 slips, T3 slips, and T5008 slips. The objective is to ensure that all relevant income and transactions have been properly reported, and that the amounts are consistent across documents. The fifth and final step is reconciliation. This is where everything comes together. Income amounts, expenses, tax slips, and investment reports are compared and matched. Reconciliation helps identify missing information, duplicate amounts, or inconsistencies before the tax return is prepared. On the left side of the slide, you'll see several important questions that every tax preparer should ask during this process. Where did the income come from? What expenses were incurred? Are there foreign investments? And are all required tax slips available? These questions help guide the review and ensure that nothing important is missed. On the right side of the slide, you'll see some of the most common mistakes. These include missing dividend income, overlooking foreign income, ignoring fees and expenses, failing to reconcile reports, and relying on only a single document. Each of these mistakes can lead to inaccurate tax reporting and potentially costly corrections later. The key message at the bottom of the slide captures the professional mindset required for this work. Never assume that one report contains everything needed for tax reporting. Investment information is often spread across multiple documents, statements, and tax slips. A good tax preparer gathers all the pieces, verifies the information, reconciles the numbers, and only then prepares the tax return. The goal is not simply to read investment reports. The goal is to analyze them systematically and transform them into complete, accurate, and reliable tax information. That disciplined approach is what separates professional tax preparation from basic data entry. In this final slide, we bring together the entire investment report analysis process and focus on the ultimate objective of a tax professional. The goal is not simply to review investment documents. The goal is to transform raw investment data into organized, accurate, and tax-ready information. Let's start on the left side of the slide. This represents the typical collection of documents provided by a client. You may receive brokerage statements, portfolio summaries, investment reports, annual tax packages, T3 slips, T5 slips, and various account statements. Each document contains pieces of information that may be relevant for tax reporting. However, these documents are not organized in the format required for a tax return. They are simply the raw materials. The tax preparer's job is to extract, verify, and organize that information. The transformation process is illustrated by the large arrow in the center of the slide. On the left, we have client documents. On the right, we have a clean tax summary. This summary organizes all of the important tax information into meaningful categories. Notice the categories listed in the tax working paper: interest income, dividend income, capital gains, foreign income, and investment expenses. Instead of searching through multiple reports, the tax preparer has consolidated everything into a single working document that can be used for tax preparation and review. This organized summary becomes the foundation for the tax return. At the bottom left, you'll see the reconciliation checklist. Before relying on the information, the tax preparer should ensure that reports have been matched, tax slips have been verified, income has been properly classified, and expenses have been identified. This reconciliation process is one of the most important quality control steps in professional tax preparation. It helps identify missing information, inconsistencies, and potential reporting errors before the return is filed. On the right side of the slide, we see the final outcome. Once the information has been analyzed, classified, reconciled, and verified, it becomes ready for inclusion in the corporate tax return. This leads to several important benefits: more accurate reporting, fewer errors, a stronger audit trail, and a more efficient tax preparation process. The insight box in the center captures the essence of this entire section. The goal is not to read reports. The goal is to transform investment reports into organized tax information. That distinction is what separates data entry from professional tax analysis. Anyone can copy numbers from a statement. A skilled tax preparer understands what the numbers mean, determines where they belong, verifies their accuracy, and organizes them into a useful tax working paper. The tax preparer's pro tip at the bottom summarizes the professional approach. The best tax preparers do not simply enter numbers from investment reports. They analyze the information. They classify it correctly. They reconcile it against supporting documents. And they verify its accuracy before it reaches the tax return. When this process is followed consistently, the result is a tax return that is accurate, defensible, audit-ready, and professionally prepared. And that is the ultimate purpose of understanding and analyzing a client's investment income reports and documents.